Hey guys, John Polemy here. Today is Friday, August 14th, and I said I would be coming out with my new public, what I'm doing in my own portfolio, but I would make it public. I've been doing that as kind of a teaser with some of these larger companies. So far, so good. Let me show you my disclaimer. The content in this video is for informational purposes only. You should not construe any such information as legal, tax, investment, financial, or other advice. All content in this video is information of a general nature and does not address the circumstances of any particular individual. Nothing in the video constitutes professional and/or financial advice, nor does any information on the video constitute a comprehensive or complete statement of the matters discussed. Basically, it's your money, it's your responsibility. So let's talk about oil down but not out. For my reference material on this, I'm using the most recent Goring and Rosenzweig Q2 report. It's about 25 pages, all about oil. They've been very bullish on it. They've been doing a lot of work on supply and demand fundamentals. And just to wind the tape back, if you've been listening to my videos for some period of time, late last year, late in the fourth quarter, we saw the oil price around $60 plus, okay? And I was becoming more and more bullish on oil companies and oil services. And we were actually starting to see really nice cash flows coming in from some of our companies. We were seeing a pickup in activity offshore, which is one of the places that I was very excited about. And then we had this coronavirus deal, and it just blew us up. But oil is down but not out. So a couple of snippets from the report. I suggest you read it. Like I said, it's 25 pages. You'll learn a lot about the energy markets. But I just want to give you some of the snippets from the report. We are on the cusp of a global energy crisis. Like most crises, the fundamental causes have been brewing for several years, but have lacked a catalyst to bring them to the attention of the public or to the average investor. This one is rooted in the underlying depletion of U.S. shales, along with the chronic disappointments in non-OPEC supply in the rest of the world. The catalyst is the coronavirus. Well, that's what happened, right? I mean, the world was basically, prior to coronavirus, was using 100 million barrels of oil per day. And after the coronavirus started getting traction, basically many governments around the world began shutting down their economies. And so there were quite a few pundits and analysts that thought oil demand would drop from 100 million barrels a day down to, by like 30 million, down to 70 million barrels a day. But that didn't happen. The real drop was a lot less than that. If you remember the tanker thesis that I talked about, one of the theses was the overwhelming amount of supply that was going to be coming onto the market that needed to be stored offshore. Now, that did happen to a certain extent, but not to the extent we thought. And that's a good thing, right? What it tells you, I think, just as a side note, is that oil is more inculcated into the economy than people think. It's not going away as quickly as people think it is. Even with a large majority of major economies around the world locked down, oil demand only dropped by about 20%, and it's been returning ever since. So let's go on here. The oil market is currently enjoying a momentary period of calm. Our models tell us this calm will be short-lived. Global energy markets in general, and oil markets in particular, are slipping into a structural deficit as we speak. Well, why are we in a calm? Because we have very large inventories right now, so it's keeping the price down. But the underlying fundamentals of depletion are at work. It's almost like termites eating away at the structure of a home. Behind the walls, you can't see it. The average person doesn't know that much about the oil market or the fundamentals of the oil market, doesn't understand the fact of depletion, inherent depletion, the fact that it's an extractive industry. You just can't put an oil well in and get oil out of it forever. I do think people do not understand that. So complacency has set in. Analysts continue to focus their attention on what has already happened, shut in of existing production, instead of looking at what is yet to come. The unprecedented drilling slowdown over the last 3 months is now starting to impact production. Going forward, supply will plummet, leaving the market in an extreme deficit starting now. I mean, we could already be in deficit. That's, if you look at the inventories, they're coming down because we're already in a supply-demand deficit. So the inventories are being sucked down. Now, the retort's going to be, well, OPEC can just open the taps up. They can overcome. But I don't think you need to read the report. You need to do some research. The amount of spare capacity that OPEC has is a lot less than you might think. It's not as easy as you think. The other retort will be, well, as soon as the oil price gets to 50 or plus 50, the shale companies are going to go nuts and start drilling again. Well, we're going to address that issue coming up. And again, another snippet from the G&R report. Investors are complacent because inventory levels remain high and are expected to buffer any future imbalance. The consensus opinion holds that demand will take years to recover to pre-pandemic levels, while production will once again surge as soon as oil reaches $50 per barrel. And that's just not going to happen for several reasons. The large reason is that capital is just not available anymore. And the impetus of the shale producers is not to produce for the sake of producing, but now, because of now 2 shale busts in 5 or 6 years, their boards of directors, the banks, the managements themselves are now focusing on their business to not just grow production for the sake of growing production by investing all cash flows, but also taking on debt. Now they are going to try to live within their cash flows. They have no choice. Investors demand a return. So incentives are shifting. Plus, banks are pulling back. Banks are not willing, after all the bankruptcies we've seen, just to throw more money at these guys to drill, and not show any positive cash flow and impair the loans. So that's number one. Number two, this thing's been going on for a decade now. When you exploit any resource, you typically go high grade. You go after the easy, cheapest to produce resources, and a lot of that has already been exploited. So anything that's still there, and there is quite a bit of oil still there, is going to be more expensive to produce and probably more complicated. We've already seen Exxon and Chevron and some other companies already take big write-downs on some of their assets. So just because you hit 50 in the next couple months, which I suspect will happen, nobody's going to go rushing back into the oil fields simply because, once bitten, twice shy. Now, eventually down the line, as prices go higher and higher, which I'm forecasting they will, and cash flows expand, they're going to get amnesia and they will head back out. But it's not going to be able to overcome some of the deficits. So let's talk about inventories. This is a chart from 9 Point Partners that I got off Twitter. Where we have been is not as important as where we are going. So this basically shows you crude oil inventory year over year surplus deficit. And you can see the end of last year, we were already moving into we were in deficit, right? And then as the coronavirus hit, and that's why prices were responding. And this was week to week, right? And what you can see now is coronavirus allowed inventories to build. But as things are beginning to loosen up, you're seeing inventories get drawn down. Why? I mean, the big demand hasn't even come back yet. Yes, we've been incremental demand coming back, but supply has got contracted. A lot of the shut-in supply was brought on now that we are at $40 a barrel, but the depletion is starting to kick in, the lack of drilling. I mean, drilling activity has collapsed by 75 or 80% just in the United States. And remember, we talked about the Red Queen's race that is shale. In order for shale production to overcome the depletion that's inherent in it, you have to run faster and faster, and that means you have to drill more and more wells just to stay even. And then you have to drill even more wells to increase production. So it's logical to suggest, and correct to suggest, that if you have reduced drilling by 75 or 80%, that you're going to have a collapse in supply, and that's what we're starting to see, and it's starting to happen. So we need to monitor this. Now, the other thing that we talked about here is some statements by some of the shale producers, Cimarex, Parsley, and Concho. And there's some commonality here. Let me read just some of these quotes from Cimarex. We are setting goals for ourselves and crafting long-term plans that allows us to focus on generating free cash flow, growing our dividend, and decreasing our debt. Okay, the days of investing every bit of our cash flow for maximum growth are gone. Okay, commodity pricing in excess of $35 will allow the opportunity to accelerate our free cash generation. So they don't intend on going back and plowing all the cash flow, if prices rise, back into new production. Here's Parsley. Our mindset is that growth capital is not needed, not justifiable in a world with significant excess spare capacity. Let's be frank. North American E&Ps are in a battle for investment relevance, not a battle for global market share. So they're committed to delivering healthy and sustainable free cash flow. Okay, here we go again. That's not going to happen if you're plowing all your money back into drilling more wells. So here's Concho. We believe the future of our industry requires better capitalized companies, more capital discipline, less leverage, that's less debt, and being more aware of market signals for growth. Okay? For most of my career, we would reinvest all our cash flow and then show our success by how much we could grow our production. That's what they were doing. That's what we saw. That's how this industry worked for a long time. Well, that's not how it's going to work in the future. Okay, so I think it probably will once oil gets to $100 a barrel, which I think it will eventually. These guys will just, they'll drop all pretenses and they'll be back out there drilling. But that's a long time from now. So what I'm trying to convey to you is that these aren't just not one-offs. This is what we're seeing. These are some of the largest, better operated companies, and they're all saying the same thing. So the idea that you may have that everybody's just going to rush back into the oil field at $50 a barrel, they're telling you that's not going to happen. They need to repair their balance sheets. They need to see what kind of cash they can generate. They need to have a return to shareholders, and they need to live within their cash flows. Now, oil isn't the only thing that's imploding supply-wise. Here's natural gas declines. These are billions of cubic feet per day between April and May 2020. So you have, the same thing happening in natural gas that you have happening in oil. So, again, I think natural gas has been in a 13-year bear market, and that may be turning around too, because not only do you have less drilling in the gas fields, you have, as they've started decreasing drilling in the shale oil fields, the associated gas you were getting gas production with that oil production, and that gas production's gone down too. So you don't have that. In the meantime, you have LNG exports now starting to rise again, and you have the potential for increased demand if we have weather event in the wintertime or even this hot summer when you have natural gas-fired electricity demand. So demand for oil and natural gas is really not as elastic as people think. It's pretty inelastic, unless you're going to turn the place into Venezuela and shut everything down. And I think, we're on the other side of the shutdowns, I think, than on the beginning. We're closer to the end of the shutdowns than we are at the start. So here's a sign of a bottom. So BP, whose CEO, his last name happens to be Looney, and I think he is Looney, they've announced a shift away from oil to greener energy sources, including natural gas, renewable fuels, wind, solar, and hydrogen. And why are they doing this? Because, ESG mandates, but also because they're saying that because of oil prices, they can't make money and blah, blah, blah. And they want to, shift over to this, renewables. BP's statement that it will reduce its carbon footprint in exploration and production by 35 to 40% by 2030 is consistent with its goal of cutting oil production by 40% through active portfolio management. Yeah, the company's $50 billion in debt, low oil prices, they're very, they've probably got huge amount of people and assets that are not producing any type of decent return on investment. So they want to pare it down, and they think the way to go is in renewables. I mean, this is classic. This is like Gordon Brown selling the UK's gold at $2.80 an ounce, which is what he did. That was, a bottom, sign of a bottom. This is a sign of a bottom. An oil company is in the oil and natural gas business and delivering and refining and delivering those products, okay? There's nothing to be ashamed of. But yet these dinks are going to get out of oil, start getting out of oil at the exact bottom and start buying into renewables, which the assets have appreciated quite a bit because it's so popular. Buy high, sell low seems to be Looney's loony idea. And, maybe this works out for them. But what I've typically seen is, these CEOs, these people in industry, they're not immune from falling into the same traps as the average investor. So BP is now targeting 50 gigawatts. That's 50,000 megawatts of renewables by 2030. That's only 10 years from now. An ambition that puts it on the level with French utility giant EDF. BP's renewables target include a 20 gigawatt goal by 2025. So in 5 years, we're going to put 20,000 megawatts up from the 2.5. So you're talking about a 10x in 5 years. I'm in this business. There's no resources available right now. The turbine manufacturers, so everybody's going great guns. I don't know where they're going to get the resources, the talent, the materials, how they're going to get this business going unless they're just going to buy somebody. And that's what was suggested in a couple articles. They would go out and buy somebody like Ørsted, which they'll end up overpaying, by the way. Now, BP has already done this once. Over 10 years ago, they created this Beyond Petroleum. When I was working at the refinery in Texas City, it was a BP refinery that happened to blow up, by the way. This is 2005. And they were in this Beyond Petroleum deal under Sir John Brown. And they went out and spent all this money on renewables, and then they quietly shelved it and sold a lot of the assets off. Now they're going to repeat history, evidently. So to me, this is more of a sign of a bottom than anything else. Oil companies should produce oil and gas. That's what they should do. And this idea that they're going to transform themselves into these renewable companies or whatever, they're going to end up overpaying, they're going to come up short, and once oil gets up to $80 or $100 a barrel, the companies that have not taken the time to create the relationships or keep their brain trust together, they're going to suffer, and BP is going to be one of them. If you own BP stock, you should sell it. They will not be successful in oil and natural gas, and I can guarantee you they will not be successful in renewables. So long story short, who's somebody that we should be looking at? Well, I'm looking at Schlumberger. It's a global oil services company. I've been buying the stock. Why? Well, if we go back to 2008, this was one of the, this had a double top here. This was back when oil was $140 a barrel. The price of the stock was like $84 a share. The last time oil made before we had the 2016 Saudi attack on shale, we saw Schlumberger top out close to 90. And so what we've seen as the business deteriorated, as oil prices have went down and shale has overwhelmed the global oil price, their business has went down as people have cut back. And then, of course, coronavirus, this thing basically got cut in half. So this is the worst oil depression probably ever, if not at least the last generation. And you can see, it's been making a small comeback. This is not going to go straight up. But what I can say is that more than likely, if my thesis is correct, these guys are basically got their fingers in everything when it comes to oil and gas, supporting oil and gas, exploration, drilling, and development. They are going to be the temperature, the barometer, if you will. And, this company has taken a lot of steps to reconcile its balance sheet. It's still cash flow positive. Yes, their revenue has declined quite a bit because activities declined quite a bit, but they've rationalized their workforce. That means there's been quite a few layoffs. and they said they will continue to do that. So what I'm suggesting to you is that this company is better suited than most for a recovery, and I think a recovery is coming. So I have this in my personal portfolio. It's not part of the Actionable Intelligence Alert portfolio. I talk about these companies. This is not a recommendation. This is something I'm doing. Why do I talk about it? Because I want you to understand my thinking. And I have companies in my portfolio. I mean, if oil goes back over the next 2, 3, 4 years to $80, $100 a barrel, like I think it will, this stock's a double at least. But I have companies in the portfolio that are going to go 5 and 10x. And what I want you to understand is my thinking, how I tie my thinking together, how my lattice work of knowledge that I take in creates these ideas. And this is one of the ideas that I have. This company's not going out of business, and they will be set up for a recovery. They've recovered many times before. They will again. So it's already, this video's gotten a little bit long. That's a short down and dirty. Oil is down but not out. And I'm playing the recovery number one as core of my portfolio, the 800-pound gorilla in the oil services market, Schlumberger. That's it for this presentation. Thanks a lot, guys, and we look forward to hearing your comments in the comments section.